Welcome to the deep dive. Today, we're really diving into something huge. It's this convergence of old school corporate finance and just massive crypto buying. We're focusing squarely on BitMine Immersion Technologies, ticker BMNR. Their story is pretty staggering, a multi-billion-dollar bet specifically on Ethereum. I mean, the announcement just a few days ago basically resets the scale for how we think about big institutions getting into crypto. BMNR now holds $11.6 billion in crypto and cash. Just like that, they're the world's biggest institutional holder of Ethereum. That's a game changer. So we've pulled together a lot of material today. Financial reports, institutional surveys, these strategy playbooks everyone's talking about. Our mission really is to unpack what this BitMine accumulation actually means. How'd they pull it off? Why Ethereum specifically? And maybe most importantly, what are the risks? Because wow, there have got to be risks when one company holds so much sway. Okay, let's unpack this.
Yeah, the scale alone demands we look closely. I mean, when you look at the numbers they reported, September 28th, 2025, $11.6 billion total. That's not just holding crypto. It's a very loud strategic statement.
And it's all about Ethereum, isn't it? Laser focus. Our CoinGecko data shows them as number one. They're sitting on, what, 2,416,054 ETH right now?
That number is already huge. It represents just over 2% of all the ETH out there. 2.0002% to be exact. But what's even more telling is their public goal. They've actually told shareholders they're aiming for what they call the alchemy of 5%.
Alchemy of 5%. Sounds dramatic.
It is. They want to control 1/20th of the entire Ethereum supply. Think about that. One company. And just for context, getting the ETH they already have cost them nearly $10 billion, almost $10 billion.
Okay, that kind of ambition, it doesn't happen quietly. The market must be reacting like crazy. BMNR trades on the NYSE, right?
Yeah.
The investor interest seems intense. Market cap around $9 billion. But the volatility, you said a 466% jump in the last year alone.
Yeah, 466%.
That's not just growth. Well, it feels like a frenzy. Is the market seeing them as a tech company? Or is BMNR stock just acting like a kind of leveraged way to bet on Ethereum?
That's exactly the tension, isn't it? The stock's behavior really points to the latter. Actually, our sources show BMNR has been consistently one of the most traded stocks in the U.S., recently around the 26th most traded overall. That level of daily volume, it's almost entirely driven by the size of their crypto stash. And what's fascinating here, as you said, is how this corporate move lines up with what we're seeing from institutions generally. Remember that 80% surge in ETH price in T3 2025? That was largely driven by institutional money. So companies like BitMine, they're not just riding the wave, they're arguably making the wave bigger. They become the vehicle for that institutional capital.
Right. So the market sees BMNR as a proxy for ETH, maybe even a leveraged one. But practically speaking, how do you even go about buying $10 billion worth of Ethereum? How does a public company justify that? There must be a playbook here.
There absolutely is. It's become known as the strategy treasury playbook. It was largely pioneered by MicroStrategy, the company that actually rebranded itself as just Strategy. Tells you something, right? And the playbook fundamentally merges corporate finance tools with managing digital assets.
Which is totally different from how companies usually manage their cash, right? Usually it's all about low risk, keeping things liquid.
Exactly. This is different. The core idea is you raise huge sums of money through selling stock, issuing convertible notes, preferred shares, whatever works with the explicit purpose of buying crypto. Bitcoin, Ethereum, Solana, and putting it straight onto the company balance sheet. Our sources suggest that companies using this playbook have collectively raised over $17 billion since just the start of 2024, all for this specific strategy.
Okay, let's zoom in on BitMine again. How did they structure their deals? How did they fund this massive ETH position?
BitMine leaned heavily on equity, selling their own stock. For instance, one earlier round, they raised $250 million by issuing equity and used that to buy about 81,380 ETH. And doing it with equity is pretty key. It lowers the refinancing risk compared to taking on billions in debt.
Right. No huge loan payments coming due down the line.
Exactly. With equity, you don't have that ticking clock, that big maturity date hanging over you. Gives them much more breathing room, especially when crypto prices are bouncing around.
That makes sense structurally, but the choice of asset is still really interesting. Why Ethereum? For a while, Bitcoin seemed like the default corporate crypto play. What shifted?
It really comes down to how they view the asset itself. It's a different philosophy. You could argue Bitcoin is often treated like, say, digital gold, a store of value. You buy it, hold it, and hope the price goes up relative to, regular currencies. That's the basic BTC treasury idea. Speculative appreciation.
Okay, so if BTC is like gold, what's staked Ethereum like in this analogy?
Staked ETH is more like owning a piece of critical infrastructure, maybe like a toll bridge or a key data network. ETH treasuries are increasingly seen as a productive capital resource.
Hmm.
Because Ethereum uses proof of stake now, companies holding ETH can stake it. That means they actively participate in securing the network, and in return, they earn yield. They get paid for holding it.
Ah, so it generates income.
Right, it provides a continuous revenue stream. We saw Bit Digital, another player in this space, reporting an average staking yield of about 3.2% back in 2024. So the ETH isn't just sitting there hoping to appreciate, it's actively generating income. That makes it a very different kind of asset for a corporate balance sheet.
That dual potential price going up plus earning yield, that really does change the corporate finance calculation, doesn't it? But does it blur the lines? Are these companies acting more like, I don't know, sophisticated hedge funds now? Where do you draw the line between smart treasury management and just pure speculation?
Well, that's the million-dollar question, isn't it? Or maybe the billion-dollar question now. But the move towards Ethereum wasn't just about the staking yield. It was also helped massively by technology improvements and clearer regulations. You had the Denkin upgrade, which cut transaction fees on layer 2s, making Ethereum much more practical for big institutional level use. And maybe the biggest catalyst was the US approving spot Ether ETFs back in July 2024. That gave big investors the regulatory green light and an easy, compliant way to get exposure without worrying about custody and all that hassle.
Okay, so BitMine seems to have found this sweet spot. A playbook to raise the cash, a productive asset in ETH generating yield, and massive institutional demand pushing the whole thing forward. It almost sounds too good to be true. But it has to be a major risk here, right? What's the fundamental vulnerability in this model?
Oh, the risk is absolutely enormous. The whole strategy, the whole advantage, it really hangs by a thread.
Hmm.
And that thread is their ability to keep raising money at a premium to their net asset value, their NAV.
Okay, walk us through NAV slowly. What does that mean here?
So think of NAV as just the current market value of all the Ethereum and cash BitMine actually holds, minus any debts they have. It's the underlying value of their assets per share. Now, their stock price, that trades openly on the market. If that market price is higher than the NAV per share, the stock's trading at a premium.
And that premium is the magic ingredient. That's the engine.
That's the engine. Exactly. When BMNR sells new stock while trading at a premium, they get more cash than the underlying ETH is technically worth at that moment. They can immediately use that cash to buy more ETH, effectively getting assets plus a bonus. It's this positive feedback loop, creating more value seemingly out of thin air. But the first big risk is what happens if that premium disappears. Premium compression.
Meaning the stock price falls closer to or even below the value of the ETH they hold.
Right. If that market to NA ratio dips below 1, meaning the stock is trading for less than the value of the ETH in their vault, suddenly selling new stock becomes dilutive. It harms the existing shareholders because you're selling shares for less than their worth based on the assets. And that breaks the whole capital raising engine. The positive feedback loop snaps.
Okay, that sounds bad. But you mentioned a second risk, potentially much scarier.
Yes, that's the negative feedback loop risk. This is where things could potentially spiral downwards fast. Let's walk through it. Step 1. Imagine crypto prices take a sharp dive. That could cause BMNR's stock premium to evaporate, maybe even turn into a discount. Step 2. Investors see this, they panic, and the stock price falls further. Step 3. Now, management is under pressure. To try and support the stock price, maybe prop it up, they might feel forced to sell some of their precious ETH treasuries.
Sell the core asset.
To buy back their own shares. On paper, this looks accretive. It boosts earnings per remaining share, but it means liquidating the very thing the company is built around.
And selling billions in ETH isn't exactly subtle. The market will notice.
Precisely. Which leads to step 4. That huge sell order for ETH hits the open market, pushing the price of Ethereum itself down even further. This, in turn, makes the NAV of BitMine's remaining holdings fall, which likely scares investors more, pushing the stock price down again. And you see the spiral. It can become the self-feeding cycle of declining confidence, asset sales, and collapsing prices, like a snake eating its own tail, as they say.
Wow. Okay, so it's incredibly leveraged to sentiment and price, using one volatile asset, ETH, to essentially back another volatile asset, their own stock. Yet despite these risks, institutions seem to be doubling down, not pulling back.
No, the commitment appears quite deep right now. Our survey data is pretty clear on this. We're seeing something like 86% of institutional investors surveyed either already have some exposure to digital assets or they plan to allocate funds in 2025. And get this, 59%, nearly two-thirds, plan to put over 5% of their total assets under management into crypto or related things next year. So BitMine, while maybe an extreme example, is definitely operating within and perhaps leading a really significant structural shift towards institutional adoption.
Okay, so summing this up, BitMine's $11.6 billion Ethereum treasury. It's become this massive real-world test case. It's where decentralized asset strategy slams right into traditional corporate finance and the company itself. It's basically become the main indicator, the barometer, for how confident big institutions really are about Ethereum's future, not just as a token, but as a revenue-generating platform.
But here's where it gets really interesting, circling back to that goal. Let's think again about their stated ambition, the alchemy of 5%. What if they actually pull it off? What if BitMine succeeds in accumulating 5% of all Ethereum?
1/20th of the entire network, controlled by one publicly traded company.
That is a level of concentration that just feels, well, it feels fundamentally at odds with the whole idea of Ethereum, doesn't it?
Yeah.
The core philosophy is decentralization, distributed control. When you have one corporate whale holding such a dominant position, it inevitably raises tough questions. Questions about governance, about their potential influence over the network, maybe even its resilience. We see discussions even in standard smart contract design about the risks of an overpowered owner. Now imagine that owner is a massive public company with legal duties to its shareholders above all else. So, knowing that 76% of institutional investors worldwide plan to increase their crypto holdings in 2025, what happens when these corporate whales, these concentrated centralized entities like BitMine, become major players? Does their very presence, their scale, start to undermine the decentralized ethos that made Ethereum so attractive in the first place? Is corporate concentration the inevitable endpoint here? That's definitely something for you to mull over.